Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Pinduoduo stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Pinduoduo is the largest online marketplace for agricultural produce. It connects farmers and distributors with consumers directly through its app or website. 12 million farmers supplied their fruits and vegetables to Pinduoduo users. It has pioneered several new trends in this area, such as sales from manufacturer directly to consumer. The company sells almost everything now, not just produce, although it did start out with just produce. They've created some really innovative ways for people like me and you to get major discounts on almost anything. For example, if I wanted to buy Logitech's $100 gaming mouse, I could go directly to Logitech and pay $100. I could also go to Pinduoduo's website and pay $100, or I can get it for a lot cheaper through Pinduoduo if I get a group of people in my network to also buy that same exact mouse. If I get a group of 20 people to buy the mouse, it may cost me only $70. I submit my payment, but I will not get charged until the entire group gets filled. I can share the deal on my social media accounts with my friends and family so they can also buy that same exact mouse. Most of the interactions are done through WeChat, which is really popular in China. In addition to my friends and family, strangers on Pinduoduo may jump into my group if they're also looking to buy the same mouse I'm looking at. This is why the company is growing so much, because people are constantly invited to the site by their friends or by social media influencers. 90% of its revenue comes from selling ad space on its platform. It also takes a piece of each transaction, and it sells merchandise of its own through the website. It has 850 million active buyers and 740 million active users. It has more users than TikTok and Snapchat. The more monthly active users, the more successful your company is, because the way these platforms make money is on ad revenue. In April 2019, Duo Farm was introduced. This is an integrated program to equip farmers with skills like e-commerce, finance, business operations, and online marketing. This service was established so farmers in impoverished parts of China could improve their productivity and find new sales using the internet. The company also operates its own logistics infosystem to track the parcels sold from its platform. It started this service to improve the efficiency of its logistics and to track and crack down on illegal activities such as online gambling and brushing. The company is headquartered in Shanghai, China, and was founded in 2015. It trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a large cap company, 121 billion market cap. They're trading at $97 a share, and they have 1.3 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have lots of free cash flow. It's over $4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is the sales for the company. And look how much that grew from 2 billion up to close to 10 billion in 2020. 2020 was a great year because of COVID. Everybody was stuck inside in China and needed food delivered to them. The revenue has come down in the trailing 12 months, but I do expect it to grow a lot in the future. This is the company's income statement. The top line is the revenue, the sales. All their financials are in Chinese ones. I converted the numbers to US dollars on my Excel spreadsheet. But if you want to know how much each dollar amount is in US dollars, an easy way to do that is just to divide by 7. A bulk of their revenue is ad space on their website. Companies bid on keywords. They also pay for banners and logos to put on the company's website. So if I type in, I want a dozen eggs, the companies that pay for ad space come out on the top of the search, just like when you search in Google. And they generated 5.8 billion ones from transactions. They take a cut of each transaction. They have a similar amount in merchandise sales. Pinduoduo buys products themselves, and they sell those products on their website to consumers. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, which is positive every year, peaking in 2020 at 40 billion. Below that is their operating expenses and then their operating income, which is negative every year. A bulk of their operating expenses are sales and marketing, then 1.5 billion in G&A expenses. This is rent, payroll, things like that. Then 7 billion in research and development. They paid $489 million of interest on their debt, but they received more interest on their investments, 1.2 billion. If somebody bought $100 of produce from a farmer, Pinduoduo holds that $100 for 2 or 3 days before giving it to the farmer. This is how a lot of banks or financial institutions make money, holding cash for a day or two before giving it to the customer. Those funds are invested in short-term, low-yielding, low-risk investments like treasury bonds and commercial paper. So you can see how much interest income they make, and the more money they hold and the more money they bring in, the more interest income they're going to generate. After ad revenue, this is probably going to be the biggest revenue generator in the future. And the bottom line of the income statement is their net income, which of course is negative every single year. This is the company's statement of cash flows. The top line is the operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. You can see they have lots of cash flow, even though they're reporting a net loss each year. They don't really have much in CapEx. Operating cash flow minus CapEx gives you your free cash flow, and they have lots of free cash flow remaining each year. But they've been adding a lot of stock, 17 billion in 2018, then 8 billion and 38 billion. They also added a lot of debt, 8 billion in 2019 and 15 billion in 2020. The reason they have positive operating cash flow is because they received $24 billion that they owe to the merchants. This is just a timing thing, so they do have to pay that money to their merchants. They're just holding it for a few days to collect the interest. And the company mentions on its website, payables to merchants appear to arise when a customer orders a product, pays for it, and the cash is held in an account waiting to be paid to the merchant. Merchant withdrawals are typically fulfilled within 2 to 4 days of a request. So it seems like the money is sitting in Pinduoduo's bank account until the merchant pulls the money. So it appears Pinduoduo's float is more than 2 or 3 days. It could be several months, depending on how long it takes the merchant to pull the money out of their account. In the company's cash flow from financing section, they invested $86 billion in short-term investments. This is all the float paid by its customers to the merchants, but the money hasn't gotten to the merchants yet. It's still sitting in Pinduoduo's bank account, so they earn interest on that money. And then when the merchants need the money, Pinduoduo has to sell the investments. They sold 55 billion of investments. So it seems like they're going to always have positive operating cash flow because there's always going to be so much money sitting in their bank accounts earning interest. The only way they'd have a big negative operating cash flow if sales decrease dramatically and most of the merchants pulled the money from Pinduoduo's bank accounts. This is the equity section of their balance sheet. They have 65 billion of equity. They raised 92 billion from selling their business, and they lost 26 billion from running their business. So they have plenty of funds to keep going and growing and scaling the business. Let's look at the capital structure. They have 10 billion of equity, 2 billion of debt. They're 84% equity, 16% debt. And they have lots of cash on their balance sheet. They can pay off all the debt with the cash on their balance sheet and still have nearly $13 billion of cash left over. Their WACC is 8.3%. That's the middle WACC on Finbox, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's 166 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $143 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of 114. They're trading at 97, so they're trading at a 15% discount. It's a buy according to the model. The average analyst projects their revenue to grow 26%. I grew their revenue 26% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. I summed up these 4 free cash flow numbers divided by these 4 revenue numbers, and that comes out to 53%. So they convert 53% of their revenue to free cash flow. So I multiplied my revenue estimates by 53%. That's how I got my future free cash flow estimates. And a lot of Chinese stocks seem really undervalued. This just seems slightly undervalued. Simply Wall Street is on another planet. They're valuing the stock at $539. They're saying it's 82% undervalued. 9 analysts priced this stock and the average price target was $133. In the past year, the stock is flat. It's trading pretty much the same place it was trading at 1 year ago. But the stock price got way up to over $200 a share. Like most Chinese stocks, there was a huge sell-off, so the stock price came way down. It fell below $80 at one point. Their beta is 1.46, so the stock moves about 1.5 times the market. It's a little volatile. It's gone up 9% in the past 52 weeks, while the S&P is up 30%. The 52-week low was 74, the high is 212. The stock is trading at its 50-day, but well below its 200-day moving average. And this is a pretty popular stock. Over 8 million shares have been traded on average the past 3 months. Of the 1.25 billion shares outstanding, 522 million are on float. 29% are held by institutions and 2% of the shares are shorted. They've been hiring a lot of people. Their employee count was really low in 2018. It's way up to 8,000 at the end of 2020. It's probably a lot higher right now. If you put $10,000 into this company when it started trading in 2018, you would have been at about $100,000 a few months ago, but you'd be at $36,000 today. That's still a 49% annual return. The founder of the company and ex-CEO is a multi-billionaire. He owns 36% of the stock. The video game giant Tencent owns 16%. Zheng Wang's fund owns 7% of the stock. Then Sequoia own 3.6% and 2.7%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales isn't so great. It's pretty high, but they're in ultra growth mode. And their price to book is also a bit weak at close to 12. They have a good current ratio and quick ratio at 1.8. They have tons of cash on their balance sheet, 92 billion Chinese wons. That's about 13 billion US dollars. And it has a lot of restricted cash. This is probably cash that's set aside to pay its merchants. So the company is well capitalized. They generated 4.3 billion of free cash flow in the trailing 12 months. They have nearly $11 billion of working capital, so they have $15 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 15 companies in the same industry as PDD, and their price to sales and price to earnings ratios are worse than average. They are doing better than average in price to book. They have a good current ratio and negative ROE since they have negative earnings. They are lower in debt than the average company, and they're a really big company, 121 billion market cap. But it's smaller than average because there's some really big companies in this industry like Amazon. So to summarize, I have them trading at a 15% discount. This seems like a great long-term play. This company is really innovative, and if they can use their technology outside of China, they can really explode. If they don't grow to the US, I'm sure there's going to be a company that's going to copy them, like Amazon or Facebook. Currently, everything is being shipped inside of China, so even if you use the app outside of China to buy things, you can't get it shipped to you unless you live in China. Also, everything's in Chinese. You could try to use Google Translate, but sometimes that doesn't work so well. But let me know in the comments if you used this company's service before and how you liked it. I ranked their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.